Turning 60 is a big milestone, and with that comes a lot of change, including the way your superannuation is taxed. In this video, we'll break down the 4 main types of taxes that apply to super for those aged 60 and over. Taxes on contributions, pension payments, lump sum withdrawals, and investment earnings. As well as a couple of ways that you might get caught out paying more tax than you had anticipated. Plus, make sure that you stick around to the end because I'll give you 2 tips on how to reduce tax that you may not have considered. Hey there, I'm Chris Strano, the founder of SUPERGUY, where we share expert tips and strategies to help you plan for a comfortable retirement. I'm also managing partner of retirement planning firm Toro Wealth. If you're new here, make sure that you click that subscribe button and hit the notifications bell so that you get notified each time I release a new video. As always, this video is general information only and does not constitute financial advice, so please read the disclaimer found in the description below. Alright, let's jump in. There's 4 main types of superannuation taxes relevant to people aged 60 and above. These include tax on super contributions, tax on pension payments, tax on lump sum withdrawals, and tax on superannuation investment earnings. Once you reach age 60, there are certain changes to the way these taxes are applied, and contrary to popular belief, not everything becomes tax-free just because you're 60. In fact, there are some traps that could lead to unexpected tax implications in situations where you thought no tax would be payable. Once you understand how the rules apply, you can not only ensure that you're not paying unnecessary taxes, but also apply strategies that will help you reduce tax. Let's get started and take a look at 4 main superannuation taxes relevant to 60-year-olds and what impact attaining age 60 has on them, beginning with contributions tax. Contributions tax is tax paid on concessional contributions made into superannuation. Concessional contributions include employer SG contributions, salary sacrifice contributions, and personal concessional contributions. Personal concessional contributions are personal contributions that you make into super and then claim a tax deduction for on your tax return. The general tax rate on these concessional contributions is 15%. However, it increases to 30% for people earning over $250,000. Now, this tax amount is deducted from your super account balance, usually at the time that the contribution is made. So what effect does turning age 60 have on contributions tax? Nothing, unfortunately. Contributions tax is payable on concessional contributions by everyone at any age. Simple as that. And as much as we hate contributions tax, it's often lower than our personal tax rate, and I'll show you how you can take full advantage of that later on in this video. The next type of tax we'll cover on is pension payments. You might be receiving pension payments if you've reached your superannuation preservation age but are still working and have decided to start a transition to retirement pension, or have retired and started an account-based pension or defined benefit pension, or are eligible to start a pension due to a disability. If this is you, then you need to understand how the pension income will be taxed. So pension payments can consist of either tax-free components or tax components, but usually a combination of both. And oversimplified, tax-free components arise from after-tax contributions to super, and tax components arise from concessional contributions to super. The tax-free portion of a pension payment will always be received tax-free, regardless of your age, but the tax component portion may be assessed for tax. That is, until you attain age 60. All pension payments are received tax-free from age 60. However, I did promise to let you know of some sneaky times that you might get caught out paying tax when you otherwise might not have expected it, and this could be one of those instances. Because despite being age 60 or over, superannuation pension income is tax-free. However, in rare cases, and for certain reasons, your super balance and subsequent pension payments may include what's called an untaxed component. If so, this portion of your income will be assessed for tax even when you're 60 or over. An untaxed component may arise from insurance proceeds within super or from certain defined benefit super schemes due to being an employee at a government or semi-government organisation where no contributions tax was deducted when your employer originally made the contribution. Unfortunately, information on whether your super balance does or does not include an untaxed component isn't usually available on your super statements, but you can contact your super fund and ask if your balance includes an untaxed component. Just be prepared that the person on the other end of the phone probably won't know what you're talking about, and if they do, you've got a super fund with well-trained staff. If you have a SMSF, just ask your accountant. Okay, moving on, our third type of tax is tax on lump sum withdrawals. Just like pension payments, if you make a lump sum withdrawal from super, the withdrawal will consist of either taxed components or tax-free components, but usually a combination of both. The tax-free portion of the lump sum withdrawal will always be received tax-free, regardless of your age, but the taxable component portion may be assessed for tax. Again, until you attain age 60. Once you reach age 60, all lump sum withdrawals are received completely tax-free, unless your balance includes the uncommon untaxed component, which you should find out prior to making the withdrawal. And finally, moving on to tax on superannuation investment earnings. To set the record straight, superannuation investment earnings are not tax-free just because you attain age 60. In fact, your age has no bearing on when superannuation earnings become tax-free, apart from the fact that you can access your super at 60 and you might commence a retirement income stream, which then does impact the retirement earnings tax. Let me explain. While you're working, your superannuation is held within a superannuation accumulation account. A superaccumulation account accepts contributions and the balance is invested in whatever way you decide to invest it. This investment portfolio will generate investment returns such as dividends, rent, interest, and so on, depending on how it's invested, and it may also increase in capital value over time. During the period that your investments are in an accumulation account, 15% tax on all investment income will be deducted from your account balance each year. Also, any realised capital gains, meaning the profit from the sale of an investment within super, will be taxed at 15%. But this capital gains tax will reduce by 1/3 to 10% if the investment sold had been owned for longer than 12 months. This is how your investment earnings are taxed, where it is in an accumulation phase of super, whether you are working or not, and whether your age is 40, 60, 80, or 180. It doesn't matter. When your super is in an accumulation account, this is how it is taxed. However, because most people retire from around age 60 onwards, they will generally use their super accumulation account to commence a retirement income stream. Once you do convert your super into an income stream, your balance remains invested just as it was in an accumulation account, and all earnings, both income and capital gains, become completely tax-free. The only requirement is that you receive at least the minimum required pension payment amounts from your account into your personal bank account each year. However, importantly, this tax-free status on investment earnings does not apply to transition to retirement pensions. Investment earnings within transition to retirement pensions are taxed identically to accumulation accounts. And that's it. That's how age 60 affects the main types of superannuation taxes. Now let's move on to the tips I promised earlier. Here's a couple of tips to reduce taxes you may not have considered before. Tip number 1, carry forward unused concessional contributions. The maximum that can be contributed into your super account as a concessional contribution each year is $27,500. However, what many people don't realise is that if you had a super balance of less than $500,000 on the most recent 30th of June, you can also contribute any unused amounts of the $27,500 cap from the previous 5 financial years. This means, in theory, you could contribute more than $150,000 into super as a concessional contribution in this financial year, including this year's cap, which gives you a personal tax deduction of $150,000 and can reduce your income tax by up to $40,000 in this year alone, even after accounting for contributions tax. Discuss this with your financial planner or accountant first to make sure that you've got it right. This is very important. I've put a link in the description below if you want to learn more. Tip number 2, TTR strategy. A common strategy for working 60-year-olds is a transition to retirement strategy, also known as a TTR strategy. A TTR strategy works by first arranging to salary sacrifice as much as you can into superannuation to reduce your taxable income. Now, this is obviously going to leave you with less take-home income, which is often not enough to cover living expenses. Therefore, the next step is generally to use a large chunk of your super to start a TTR pension, which you can do once you reach age 60, even if you're still working. A TTR pension provides you with tax-free income that is then used to top up the shortfall that arose from salary sacrificing. So what you're basically doing is swapping taxable income for tax-free income and ultimately putting more in super. Same after-tax income, but less tax. I hope you got some value from this video. If you did, remember to click the thumbs up button to show that you liked it and the subscribe button for more content. For even more tips, head over to superguy.com.au and subscribe to my newsletter for regular tips. It's free.